growth covers a lot of sins or bad behavior. Bad behavior might be taking on more debt, taking on more risk generally than companies and consumers should. And we do believe that that is what is going on right now, that the government is grappling with this and trying to manage it.
In this video, let's join Cathie Wood, CEO of ARK Invest, as she delves into the intriguing realm where AI certainty collides with economic uncertainty. Cathie takes us on a fast-paced journey through fiscal and monetary policies, exploring crucial economic indicators. She shares her expert analysis on employment data, inflation trends, and GDP revisions, all while shedding light on the true impact of innovation in the equity markets. Welcome.
They don't want to ease too much because they're fearful of inflation expectations and continued speculation on property. And so we think that's a real depressant on the world. Now, going quickly through market indicators, S&P was up nicely in June. And so a lot of that, as we've seen, has been focused on the mega tech category, what people are calling the Magnificent Seven now. And some of them will be prime beneficiaries of this excitement about, and we believe that the excitement is real and justified about artificial intelligence. But we think that there are other areas of the market besides the Magnificent Seven that will also benefit. And I think our strategies, or some of our strategies, were a testimony to that in the first half of the year. You know, interestingly, in our broadest strategy, we have 25% in healthcare and an overweighting relative to the broad-based indices like the QQQs or the NASDAQ 100 as they are called. So we're much more heavily weighted to small and mid-cap, and to be able to have outperformed the NASDAQ 100 in any of our strategies is testimony, we think, to the return of active management. There are investors out there who do not religiously depend on the broad-based indices, but are doing their homework and are saying and asking the question, who is really going to benefit from this massive shift towards artificial intelligence, which is gaining so much momentum because AI training costs are dropping 70% per year. And they're coming up with good answers, we would say. This is what we do all the time, and it's nice to have the company again, if I might say. Long-term interest rates, they moved up from 364 today, 405. Interesting, we're getting a good test here. In March, the 10-year Treasury bond yield peaked around 4.8 to 410. Today it's 405. In October before that, it had a peak at 4.3. So lower highs, we are having a little bit of a test here. And we'd be surprised to see long rates continue to move out because of the weakness that we see evolving in the economy, and because inflation's coming down, and because it could be negative, which I think would shock a lot of people. I was around, did a roadshow in Europe last week, and I asked the question, how many of you here are hearing forecasters talk about deflation? Nobody. Maybe one hand went up, and I said, I think you heard us talking about that. We think innovation broadly is going to become a flight to safety category. We think most investors are very short innovation. They may think they have it covered with the Magnificent Seven, as they're being called now. But we do not think they do. In fact, we think there's going to be some disruption to the Magnificent Seven, and we can get into that in another time. And we've mentioned ChatGPT as a real risk to search and Google's entire model. And there are other risks in the what used to be called FANGs, or now the Magnificent Seven, some of which is even competition for the AI chip world. We think that autos have been a great case in point here. The shift towards electric is happening so much more quickly than I think the auto industry first expected and auto analysts expected, that many investors are on guard now, thinking, okay, innovation, I'm going to take it more seriously. And we think that AI is going to turbocharge the speed at which these shifts take place. And so let's just talk about AI a bit. We think there's going to be a lot of commoditization coming out of AI. As you listened to Frank Downing and Will Summerlin on our last In the Know, foundation models could be commoditized. And commoditization is great for companies who harness the AI that is being commoditized to increase their productivity, increase their efficiency, and lower their unit labor costs. So that's great. That could be a boon to the entire economy. But the companies who will really benefit disproportionately are going to be those with visionary leaders, broad-based distribution, and after those two, most importantly, proprietary data that no one else has. And so that's what we spend our time focused on as we are thinking about AI. We think this move into the megatechs around AI has been more knee-jerk, and it will sort itself out as more and more people do the research. So with that, I'll close by saying, innovation solves problems. We've said that since the beginning of COVID. That's when I started doing these In the Know videos. And I believe with the margin pressures that corporations are going to face, they're going to have even more problems moving forward. So innovation, AI, they're certainly going to make use of it. Innovation, as we saw with Bitcoin around regional bank crisis, is a flight to safety. And one of the flights to safety that investors must consider is the traditional world order being disrupted magnificently by the 5 major innovation platforms around which we have centered our research: multi-omic sequencing, robotics, energy storage, artificial intelligence, and blockchain technology. And the convergence between and among those technologies is going to cause super exponential growth for some, but creative destruction for others. And so we believe in the next 5 to 10 years that investors who are short true innovation, truly disruptive innovation, are going to start moving more and more into that space, allocating capital to its highest and best use.